I do believe that the economic data that is going to be coming out in the weeks and months ahead is going to be negative data. It's going to be negative on the economy, negative on manufacturing. They're going to have some negative jobs numbers, and the stronger inflation numbers may not show up for another few months, right? I mean, they may come out around where they are. And so as long as inflation isn't getting worse, right, the Fed can ignore the data because the Fed is already confident, right? They're saying we know that inflation is going to go back down to 2%, although Powell was careful not to say mission accomplished, because he actually said that. There was one of the reporters that asked, would you say you've won the inflation fight? And Powell said no, which kind of contradicted what he said earlier about the confidence he had. And that's why he cut by 50 basis points, because he was so sure that inflation was going down to 2%. But then he later said, well, we're not sure, and so we're not going to say mission accomplished. Well, then if you're not sure, why'd you cut by 50, right? So nobody really asked that. But I think he was afraid to say mission accomplished because, it's probably not accomplished. So he came out with that. And so that might have also been a negative for the market. Maybe the markets were waiting for him to say, yeah, mission accomplished. Although from my perspective, he basically did that with the 50 basis point rate cut. But again, remember, when inflation was below 2% and rising, Powell never raised interest rates to get ahead of inflation, say, look, we can see it's going up, so we're not going to wait for 2%. We're just going to start hiking now before we get there. No. Powell actually said, we're going to let it pass 2%, right? Even though our target is 2%, we're not going to start hiking at 2%. We're going to let it get above 2% before we start hiking because, we want to average out inflation, right? We have this inflation averaging now. So we're not going to rush, right? We're just going to, let inflation move above. Well, they have the complete opposite attitude on the way down. If the Fed was consistent, the Fed would say, we're not going to start cutting rates until inflation is below 2%. And in fact, what Powell should be saying is, we were above 2%. We were way above it. We need to average that down. We need to have inflation run below 2%. And if the economy really was as strong as Powell claims, why not? Why not let inflation be below 2%? We got this great economy. We got this super strong labor market. Why not have 1% inflation? I mean, wouldn't that be a relief? Although that's still higher prices. But no, Powell knows the economy is so weak, he can't wait for inflation to actually get down to 2%, or heaven forbid, go below 2%. He needs to start cutting now, and he's just going to roll the dice and hope that inflation keeps coming down. But why should it? He's throwing gasoline on the fire. Why should the fire go out when he's now stoking it?
Peter Schiff's insights on the current economic landscape paint a clear picture of how deeply intertwined interest rates, inflation, and the value of precious metals like gold and silver have become in today's financial system. The idea that inflation is not just a temporary challenge but a systemic flaw caused by years of poor monetary policy is at the heart of his argument. Let's dive deeper into his key points and explore why gold and silver remain central to any strategy designed to preserve wealth in an increasingly unstable economy. The Federal Reserve's approach to controlling inflation through interest rate manipulation is fundamentally flawed, according to Schiff. Over the past 2 decades, the Fed has kept interest rates at historic lows, creating what Schiff describes as an illusion of prosperity. Low interest rates have driven massive borrowing, not just by individuals and businesses, but by the government itself, leading to an unsustainable level of debt. This cheap money policy has inflated asset bubbles in real estate, stocks, and bonds, giving the impression that the economy is stronger than it actually is. However, when inflation began to rise, the Fed found itself in a bind. Raising interest rates to control inflation would crash the asset bubbles it had spent years inflating, while continuing to keep rates low would risk letting inflation spiral out of control. Schiff argues that the Fed has chosen the latter option by cutting interest rates preemptively, despite inflation still being well above its 2% target. This signals weakness, not strength, in the U.S. economy, as the Fed is essentially betting that inflation will come down on its own, rather than taking the hard steps necessary to control it. But inflation doesn't just disappear. In fact, Cutting rates while inflation is still high is like pouring gasoline on a fire. The more the Fed cuts, the more likely it is that inflation will accelerate. This is particularly concerning in the context of the current deglobalization trend, which is reversing the deflationary forces that have kept inflation in check for so long. As companies bring manufacturing back to the US, the cost of goods and services will rise, pushing inflation higher. This will put further pressure on the Fed to either raise rates and risk a recession, or let inflation run wild. In an environment where inflation is not just a short-term problem, but a long-term systemic issue, gold and silver are more important than ever. Both metals have historically been seen as safe havens during times of economic uncertainty, and Schiff argues that we are now entering one of those periods. With inflation set to rise and the Fed's ability to control it in question, gold and silver offer protection against the erosion of purchasing power. One of the most compelling aspects of gold is its intrinsic value. Unlike fiat currencies, which can be printed at will by central banks, gold is finite. This makes it a natural hedge against inflation, as its value tends to rise when the value of paper money falls. As Schiff points out, gold has already rallied to near-record highs, and it is likely to break through the $2,600 mark in the near future as inflation continues to accelerate. Silver, too, is positioned for significant gains. While gold is often seen as the primary store of value, silver has a unique dual role as both a precious metal and an industrial metal. Silver is used in a wide range of industrial applications, including electronics, solar panels, and electric vehicles. As demand for these products continues to grow, the supply of silver will become increasingly constrained, driving up prices. In fact, silver is still trading below $31 per ounce, making it a bargain compared to its long-term potential. Schiff believes that both metals are currently undervalued, particularly in relation to the US dollar. As the dollar weakens, the price of gold and silver will rise in response, reflecting the declining purchasing power of fiat currencies.
The markets initially rallied, the stock market rallied. Gold, as soon as the announcement came out that it was 50 basis points, gold rallied and then rallied again. It didn't take out 2,600. It did make a new all-time record high. We got above 2,595. And the gold stocks had a big rally initially. So the GDX and the GDXJ both hit new 52-week highs earlier. But then when Powell started to speak and some of the things that he was saying was interpreted as being, hawkish, like he talked about how strong the economy is. But what did they expect? He's not going to acknowledge that the economy is weak. When asked specifically about the balance of risks, if they had tilted to employment over inflation, Powell said no. He said that it's basically neutral, that the Fed is equally worried about inflation and employment. So it's not that it's more worried about unemployment, but that was a lie. Of course it's more worried about unemployment. That's why it's cutting, because the idea that they're tight is nonsense. They're still loose, and so they're cutting because they need to be looser for a lot of reasons. One of them is employment. But I think when Powell said that, that kind of spooked the markets. Also, Powell said that, hey, don't expect, just because we cut 50 basis points this time, we may not cut 50 next time, right? And we may not cut it all next time. We're still playing it meeting by meeting. We're data dependent, going back to that. Even though all the people who fill out these dot plots, they're all projecting more cuts. Powell didn't just come out and say, yeah, we're cutting again. We're cutting next meeting. We're cutting the meeting after that. He kind of, claimed that, well, we're still data dependent, so you never know. If we get some bad inflation prints, we may not cut. Hey, we may even hike, right? So he left the door open. And so I think that, took away some of what he had given. And that's one of the reasons you saw reversals in the markets, including the fact that, it's a buy the rumor, sell the facts. So you get traders taking profits. So the market sold off and went negative. It wasn't a collapse, but they lost the gains. Gold reversed, closed negative on the day, maybe about 10, 12 bucks. I think at its highs, gold was up maybe like $25, something like that. So the gold stocks, which were up 3-4% on their highs, ended up down about 1%. So a lot of profit taking as a result of the press conference. But I think that's just a one-day event. I think what happened was extremely bullish for gold, and I think the big move is going to be higher. I think the next rally will take out 2,600. Same thing with the dollar. Dollar made a new low for the year on the yen, almost took out a 140. We did take out 84 cents on the Swiss franc. We closed back above it, but that was a new 13-year low today in the dollar against the Swiss franc. So, the dollar is slowly starting to break down. The pace of that breakdown is going to pick up now that the cat is out of the bag. We've had this 50 basis point rate cut, and we've got more rate cuts coming, right? So the dollar is going to go down, gold is going to go up, and so this was just an opportunity. This late day sell-off is another opportunity. So if you didn't buy more gold before the Fed cut 50 basis points, you can still buy it tonight. You can still buy silver. Silver, is still above $30, but it's below 31. It had gotten above there. But silver is a good buy right now.
Schiff brings up an essential point about the cyclical nature of inflation and deflation. The Federal Reserve's ultimate tools for controlling inflation, interest rates, and monetary policy are meant to combat these forces. However, over the past few decades, the Fed has driven interest rates to historical lows, even keeping them near zero for extended periods. Low interest rates have encouraged borrowing and spending, stimulating growth but also creating massive bubbles in various asset classes, particularly real estate and stocks. As Schiff describes it, lowering interest rates to stimulate inflation is akin to throwing gasoline on a fire. When you cut rates, you make borrowing cheaper, encouraging people to take on more debt. But what happens when inflation rises faster than the economy grows? This scenario sets the stage for economic stagflation, where inflation persists while the economy stagnates or contracts. Schiff warns that the Fed's actions, particularly its recent 50 basis point rate cut, are creating the perfect conditions for this to happen. Another interesting observation Schiff makes is about how globalization and technological advancements have masked inflationary pressures for decades. Cheap labor from countries like China and advancements in technology have allowed prices to stay relatively stable, even as central banks flooded the markets with liquidity. But now, with the push for deglobalization and the return of manufacturing to domestic shores, the inflationary pressures are starting to build again. Rebuilding supply chains, paying higher wages, and dealing with tariffs and trade wars are inflationary forces that can no longer be ignored. Gold and silver have always been seen as the ultimate hedges against inflation and economic uncertainty. Unlike fiat currencies, which can be printed endlessly, gold and silver are finite resources. Schiff's analysis aligns with the sentiment that as inflation heats up, gold will serve as a barometer for the declining purchasing power of fiat currencies like the US dollar. In his discussion, Schiff mentions that gold rallied after the Fed's announcement of the 50 basis point rate cut. Gold surged above $2,595, and although it didn't break through the $2,600 level, the market reaction signals that gold is poised for further gains. Gold is not just a store of value. It is a reflection of the market's lack of confidence in central banks and fiat currencies. However, gold wasn't the only beneficiary. Silver, too, has experienced an increase, staying above $30 per ounce. Schiff believes that silver remains an excellent buy, especially as the industrial applications of silver continue to grow. From solar panels to electric vehicles and other green technologies, the demand for silver will only increase in the coming years. This positions silver as both an industrial metal and a monetary metal, making it an attractive investment in today's environment. One of Schiff's key themes is the slow decline of the US dollar. While the dollar has remained the world's reserve currency for decades, the cracks are starting to show. Countries like China, Russia, and other emerging markets are beginning to challenge the dollar's dominance by creating alternative payment systems, buying up gold reserves, and reducing their dependence on U.S. financial systems like SWIFT. The de-dollarization trend is gaining momentum, and the recent strength in gold is a reflection of this global shift. Schiff notes that the dollar made a new low against the yen and the Swiss franc, both traditionally seen as safe haven currencies. This decline in the dollar against other strong currencies signals that international investors are losing confidence in the U.S. financial system. As the dollar weakens, Schiff argues that gold and silver will continue to rise in value as investors look for alternatives to store their wealth. The next big move in gold, according to Schiff, will likely break through the $2,600 level, and he expects the dollar's decline to accelerate in the coming months. With central banks around the world continuing to cut rates and inject liquidity into their economies, the global currency markets are primed for a shakeup. Schiff believes that the US dollar will bear the brunt of this adjustment, and as confidence in the dollar wanes, gold and silver will soar to new heights. One of Schiff's mantras is the importance of holding physical metals, particularly gold and silver. Unlike paper contracts or ETFs, physical gold and silver have no counterparty risk. As he often says, if you don't hold it, you don't own it. The idea here is simple. Fiat currencies can be manipulated, but gold and silver are tangible assets that retain value regardless of what happens to the economy or the financial system. Schiff also highlights the fact that ETFs and other financial products that claim to be backed by physical metals are not the same as holding the actual metal. In a crisis, these paper products could be rendered worthless if their issuers go bankrupt or refuse to honor their contracts. In contrast, physical gold and silver are universally recognized and accepted forms of money. For those who might not fully grasp why inflation is such a big deal, Schiff's analysis provides some eye-opening points. Inflation doesn't just erode the value of your savings, it also distorts the entire economic system. When inflation is high, the cost of goods and services rises, but wages and income don't always keep pace. This creates a squeeze on consumers, who find themselves paying more for everyday items like food, energy, and healthcare, while their real incomes decline. What's worse, inflation disproportionately affects the middle and lower classes, who spend a larger share of their income on basic necessities. The wealthy can often hedge against inflation by investing in assets like real estate, stocks, and of course, precious metals. But for the average person, inflation is a tax on their standard of living. Schiff emphasizes that by investing in gold and silver, individuals can protect themselves from this hidden tax. As Schiff's analysis reveals, the economic data in the coming months will likely paint a picture of continued weakness, and central banks will respond by printing more money and cutting interest rates further. While this may provide short-term relief for the stock market and other asset bubbles, the long-term consequences are clear. Inflation will rise, the dollar will weaken, and gold and silver will continue their upward march. For investors, the key takeaway is simple. Don't wait. The window of opportunity to buy gold and silver at relatively low prices is closing. Whether you're looking to preserve your wealth, hedge against inflation, or simply diversify your portfolio, now is the time to act. As Peter Schiff would say, when the next crisis hits, you don't want to be holding paper promises. You want to be holding real money, gold and silver.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.